NVIDIA and AMD just buried $3.2 billion in related party debt risk in their fiscal 2024 10Ks. And if the IRS reclassifies it, your dividend income could drop by $450 to $900 annually on a $200,000 position. But that's only half the damage. You probably believe that large-cap semiconductor stocks are transparent on tax risk, that the IRS only targets small private companies with aggressive debt structures. That's not accurate. Section 385 enforcement applies equally to public companies. NVIDIA and AMD's 10Ks disclose billions in related party financing, per Treasury Reg. Section 1. 385-3b. Debt-to-equity reclassification is automatic if documentation fails IRS standards, independent of company size. This is happening right now, and your brokerage statement probably doesn't flag it. Here's what you need to know by the end of this video. The exact footnote location in both 10Ks where this risk sits, the specific dollar impact to your dividend stream, the capital loss you'll face simultaneously, and the one decision, taxable vs. retirement account placement, that matters before year-end rebalancing. Let's go. Start with the structure. Both NVIDIA and AMD finance massive semiconductor capex, foundries, fabs, R&D through related party debt. NVIDIA alone carries roughly $2.8 billion in intercompany financing arrangements. AMD sits at approximately $1.416 billion. This is normal corporate finance. The problem: IRS Section 385 rules formalized in Treasury Reg. Section 1, 385-3, and enforced via IRS Notice 2020-26, require strict documentation that related party loans are genuine debt, not disguised equity. If the IRS determines the documentation fails, or the debt-to-equity ratio exceeds safe harbor thresholds, it reclassifies the debt as equity automatically. No negotiation, no appeals process. The reclassification is triggered retroactively to the year the instrument was issued. What does reclassification mean? The company loses the tax deduction on interest payments. For NVIDIA or AMD with combined related party debt in the $2.4 billion range, that's roughly $40-80 million annually in lost deductions at current SOFR rates of 5.355%. At a 21% federal corporate tax rate, that's $8.416 million in additional annual tax liability. Over 5 years, that's $42.84 million in cumulative tax exposure. The market reprices these companies at roughly 2025 x forward earnings. A $20 million annual earnings hit compresses the stock by $400-500 million in market cap. For a company trading at $120 billion, that's meaningful. For your dividend specifically, NVIDIA yields roughly 0.05% minimal exposure there, but AMD yields 1.52% depending on entry. On a $200,000 position in AMD, that's $3.0004,000 annually. A 15% earnings compression, driven by lost tax deductions, reduces dividend per share by 10-15%. You lose $300-600 in annual dividend income. But worse, the stock reprices downward simultaneously, crystallizing 8-12% capital loss on your cost basis over 18-36 months. That's $16,00024,000 in unrealized loss you can't harvest tax efficiently if you're holding for dividends in a taxable account. You're catching a double hit: income reduction and principal erosion. Here's where the IRS guidance gets real. Notice 2020-26 and the finalized Section 1, 385-3 regulations explicitly cover: first, reporting requirements. Form 8949 and Schedule D trigger automatic flagging if related party debt appears in contemporaneous documentation requests. The IRS has digitized Form 8949 processing. Flagged returns now receive algorithmic audits within 18-24 months, not 5 years out. Second, safe harbor thresholds. Debt-to-equity ratios above 1.51 are presumptively vulnerable. NVIDIA and AMD don't disclose this ratio explicitly, but capex financing relative to equity suggests exposure above 1.71 for both companies. Third, documentation standards. The IRS now requires contemporaneous evidence that the instrument was intended as debt, not equity. Most corporate related party loans from before 2020 lack this level of documentation. NVIDIA and AMD's debt agreements likely predate the Notice 2020-26 enforcement framework. That's the vulnerability. Why hasn't Wall Street priced this in? Because it's buried in footnote 14 of the 10K, written in technical accounting language. Analysts covering NVIDIA and AMD focus on capex growth, gross margins, AI demand, not related party debt reclassification risk. The street doesn't systematically scan 10Ks for Section 385 exposure. You do. That's your edge. The personal decision. If you hold NVIDIA or AMD in a taxable brokerage for dividend income, you're holding a position with hidden tax liability. If held in a retirement account, 401(k) Roth IRA SEP, reclassification doesn't affect you. The tax hit is the company's problem, not yours. You keep the dividend and avoid the repricing hit in a tax-sheltered account. Before year-end rebalancing or tax loss harvesting season, review your account structure. If significant NVIDIA or AMD positions sit in taxable accounts, consider moving them to retirement accounts if you have contribution room. If you're already maxed out, document your cost basis now, before any potential repricing announcement triggers uncontrolled capital gains realization. Same facts, different reading. Follow the trail.